In this video, I'll be breaking down the investment strategy on the road to unlock financial freedom, starting from zero. And here's a quick question. Do you want to quit your 9-to-5 job and instead use that time to do whatever you want? I sure do. I'm sure most of you guys do as well. That's why on social media, like for example YouTube, there's tons of ads out there that's talking about purchase this and then you'll be unlocking $100,000 in 7 days. Or don't buy this, don't do this strategy, otherwise you'll be losing all your money. However, before we even get to the investment portfolio, I want to discuss a correct mindset and investment strategy to secure your wealth. Remember, wealth isn't defined by how much you earn. Rather, it is defined by how many days could you survive if you stop working today. First of all, stop being so constrained in your day job and start thinking outside the box. Start making and building additional income streams and accumulate cash. I was also in the same mindset, thinking that my day job defined my success. I would work extra hours to prove that I'm hardworking, and I thought promotion and salary increase was the key to unlock financial freedom. I realized that this wasn't true though. When I quit my full-time job, I actually found a side hustle that generated an income that was double of my previous year's salary in just 6 months. I'm not saying that you should quit your day job and aimlessly look for a side hustle. I am saying is that you shouldn't fill all your time with your day job, otherwise you won't have time to scale your finances. Start focusing your time on finding a side hustle, or maybe even create your own scalable side business. Here's another aspect I want to discuss, which is the scalable lifestyle. Here's a very simple question. If one man makes $40,000 a year and he saved $10,000, whereas another person makes $100,000 but he saves nothing, who do you think is actually wealthier? Well, it's definitely the first person. Again, wealth isn't defined by how much you earn, but rather what's your generated income minus your expenses. And in this case, the money can be saved or even better reinvested so that they work one less day in the future. This means that rich people actually starts with a humble lifestyle. They save the money, they don't just go out and purchase their dream car with their first $100,000. They reinvest that so that it will be compounded for future returns. There are some expenses that you must pay and you should pay very diligently. This leads to my second point, which is paying off your high interest debt, for example, credit card and payday loans. Credit cards are actually good, and I suggest everyone to get one as soon as possible. Because in many countries, you need your credit card for a higher credit score, which could help you with mortgage loans or large expenses down the road. However, credit card also has one of the highest interest rates. Most of the time, it is above 20%, which is charged as soon as the monthly deadline hits. And don't get into that trap where some credit cards may say, pay this minimum amount by this deadline. You should always pay your full amount to avoid any interest. My third point is to start building your emergency fund. An emergency fund is cash flow that can be easily taken out and it should cover about 3 to 6 months of your living expenses. The main goal of emergency fund is to protect your investment. If you ever decide to quit your job, or perhaps you get into a situation where you need a large sum of money, you don't have to tap into your investment, because if you sell your investment during that time, it could be a bad timing, you could lose out on certain profits, or even worse, lose your original investment. Great! Now that you have paid off your high interest debt, you have emergency fund, and you have a great mindset on how to be wealthy, and also you have disposable income for investment. The fun time begins, right? Well, yes and no. Point 4 is here to emphasize that you should not be distracted by these next great investment ad. For example, some YouTubers might be telling you shilling about the next Bitcoin, or maybe you see an ad saying that invest in this NFT project and that can get you hundreds of thousands of dollars in a few months. I have personally gone through that, so I'm here to tell you to not FOMO. I've lost money. FOMO means fear of missing out. Stick to your investment strategy and do not cave in to people telling you that they made $1 million in the last 3 months. If you're consistent with your strategy, you'll reach financial freedom. Alright, time to start the fun bits. Investment. Point number 5 is about index fund. Index fund is one of the lowest risk and one of the safest options out there. It is a portfolio of companies that matches a portion of the financial market. The most common one that you may have heard of is the Standard & Poor's 500 index, also known as S&P 500. It consists of around 500 leading public traded companies in the US, and at the current time, that's about 75% of the US stock market capitalization. Index funds are great because it's very easy to get into and it's very low risk for long-term investment. The reason why it is low risk is because the rebalancing is done for you on a regular basis. And since its inception in 1926 to now, the average annualized return is about 10.5%. This means that if you put in $500 a month in the next 30 years in the S&P 500, then in 30 years, you'll be getting more than $1 million in your portfolio. That's 600% increase compared to if you just hold it in the bank. There's different ways of purchasing index funds. For example, through ETFs or maybe mutual funds. Without getting into too much technical detail, I do suggest ETFs because mutual funds generally has way more fees. And mutual funds essentially has a portfolio manager that will be actively trading within your portfolio so that they can try and beat their benchmark index. However, statistically speaking, more than 90% of these fund managers are generally underperforming compared to the benchmark index. Popular ETFs include SPY or VOO for the S&P 500, or the VTI for the total stock market, or the NASDAQ for the NASDAQ 100. Majority of the people have most of their portfolio in index funds. Following up to this point, I'll be discussing two main investing strategies, and point 6 is the first one, which is passive investment. Passive investments are great and goes well with index funds. The investors are usually there for the long run, and for example, hodlers. So passive investors usually limit the amount of transaction in the stock market, hence reducing the amount of fee they have to pay for buying and selling these stocks. Also, they will be reducing the risk associated with timing the market. As the famous saying goes, it's not about timing the market, but rather time in the market. This is especially true because nobody really knows where is the top of the market or bottom of the market. However, if you're there for the long run, especially with index fund, which is generally trending up, you'll be really having low risk anyways. So a great strategy that goes well within passive investment is called dollar cost averaging, which is DCA. This just means that an investor will be dividing up their total amount into periodical purchases. For example, maybe you'll be taking out $250 or $500 every 2 weeks from your paycheck into your investment. This will average out to reduce the volatility of the stock market, and also you'll reduce the risk of perhaps maybe you're purchasing a large sum of money in the wrong timing at the stock market. Point number 7 is about active investment. I only suggest this if you have time to learn about the market, the business, and the industry. Investment is very different from trading. For example, there's more emphasis on the business rather than the technical analysis. You often have to be more patient with the market. For example, in 2019, Warren Buffett, as part of the Berkshire Hathaway, they held a large sum of cash because they thought the stock market was overvalued. In hindsight, perhaps that wasn't the best scenario because the stock market actually kept rising up even after the huge correction in 2020 for the COVID. However, it is always important to learn how to be patient as an active investor. Another popular financial theory is the reversion to the mean. This means that for the asset price volatility and historical return in the long term will most likely revert to the mean. This means that, for example, if the Tesla stocks are spiking up dramatically in the short term, it's most likely that it will dip back down in the retracement as part of that reversion to the mean. It doesn't matter if the long-term trend is consistently going up. In 2022, we're facing rising high inflation, and this means the price of good is going up, whereas the purchasing power of every dollar is going down. Warren Buffett has emphasized that it's important to pick out the right company during these times, and two of his main focus points is number one, picking out a company that have the ability to increase price without significant loss in their market share or their unit volume. So companies that have a competitive edge, such as Apple or Coca-Cola, which of course is a big part of his portfolio. Number two, companies that have the ability to increase dollar volume without a significant cost to the investment capital. So a low investment cost. So companies that are scalable. Also, there is increases in interest rate recently. This generally means large investors will shift from investing in riskier assets such as stocks into less riskier assets such as government bonds. And all of these factors I described previously could contribute to the recent corrections in the stock market. As you can see, there's so many things to learn in active investment. I definitely suggest understanding the market and the business before you actually go into active investment. This leads to my 8th point, which is do your own research and do not cast your net so wide with too many individual stocks. Yes, diversity is good because it reduces the risk of having too many stocks in one single sector. However, nobody has the time to actually understand more than 10 to 15 individual companies. And because you have majority of your portfolio in index fund, this already dramatically reduces your risk. Hence, you can spend your time and money on the sectors and industries that you are interested in. I suggest understanding the company's quarterly earnings report. So for example, their balance sheet, their income, and their cash flow. Understand what's their competitive advantage. Is their technology forward-looking? For example, are they being innovative? Also understand their management integrity and what's the community and the market sentiment about their management team. Management team is a crucial component of the company's future vision and growth. Lastly, understand the margin of safety. So try to see if the market price is actually lower than the intrinsic value of the stock. That means it's a great time to purchase that stock. So my point number 9 is about investing in real estate. And this is a huge part as well. I currently do not have the capital to purchase a real estate and I am saving up for it. And I think this is a great place to diversify my portfolio. So investing in real estate is a huge part and honestly differs from place to place. So you definitely need to do your research and understand the real estate market in your area. There are two main investors in real estate. Number one is capital gains investor. Usually these people will be purchasing real estate at a cheaper price, renovate them, and then flip them for a higher price. Second is cash flow investors. And this is what I want to become, where I'll be purchasing the real estate, maybe rent it out, so that it'll be generating cash flow on a monthly basis. I can use this money then to pay for my mortgage for the real estate and also perhaps for reinvestment on my other investment portfolios. My last but not least point is tax strategy. This is an important aspect that any investor needs to practice so that they can be legally minimizing their tax and increasing their income. If you haven't done it before, make sure that you do your taxes yourself once. Understand the concepts such as tax brackets, tax credits, tax deductions, tax-free savings account, retirement accounts, etc. In US, there is retirement accounts such as 401k, IRA, as well as TFSA, which is tax-free savings account. In Canada, we have TFSA as well and RSP for retirement accounts. I hope you enjoyed the video, and if you did, please smash that like button and consider subscribing to the channel. Also, you can leave in the comment section below on what video for investment or personal finance that you would like to see next. Until next time.